On January 15, 2023, in the heart of Manhattan, New York City, a significant event began to unfold. At the headquarters of FinTech Dynamics, a small yet influential technology company specializing in financial algorithms, a team of data scientists initiated an update to their widely adopted predictive modeling software. This algorithm, integral to financial forecasting, was used by numerous banks and investment firms to assess and optimize their portfolios. Its influence extended across the industry, affecting billions in investments. As the team implemented adjustments aimed at improving the algorithm's accuracy, a critical technical failure occurred due to an oversight in the configuration settings. Specifically, the update inadvertently altered the weightings of various market indicators, leading to an inflated projection of potential investment returns. The access vector for this issue stemmed from a minor misconfiguration in the algorithm's code, where a single line change in the software introduced erroneous coefficients into the predictive models. The absence of rigorous testing protocols further exacerbated the problem, as the team failed to review the implications of the adjustment thoroughly. By January 20th, the fallout from the initial incident was already beginning to manifest. Financial institutions utilizing the flawed algorithm reported an aggregate overestimation of returns by an alarming average of 25%. Reports showed that 50 major banks, leveraging the updated forecasts, collectively allocated more than $10 billion into high-risk assets based on these distorted projections. As the trading week progressed, discrepancies became apparent, with many firms realizing that the expected profitability did not align with their actual performance. Internal reactions within FinTech Dynamics were mixed. An initial email thread, populated with confusion, threaded through the organization's communication channels. Team members raised questions about anomalies in user feedback and began to investigate the discrepancies further. Panic set in as the realization hit. The recent modifications could significantly impact clients relying on accurate data and predictive modeling. Some team members proposed partial fixes, suggesting a rollback to the previous algorithm version, but others believed a detailed analysis would better serve their clients in the long run. Assumptions were made regarding the overall resilience of the financial system, with predictions leaning towards a rapid recovery once the immediate issue was addressed. Externally, user reports began flooding in from numerous banks as financial analysts and traders experienced unexpected losses. Monitoring systems showed spikes in volatility, and alerts warned of unusual trading patterns across several stocks. Media outlets picked up on the growing concerns, leading to minor mentions in financial news that highlighted unexpected market behavior, but without a clear understanding of the underlying causes. Some reports indicated that several hedge funds were quietly adjusting their positions, further hinting at the mounting pressure within the markets that had yet to reach a broader audience. As the week progressed, the scale of the impacts became increasingly significant. On January 25th, a group of investment banks convened to discuss the ramifications of the inflated return projections. Collectively, their internal analyses suggested a potential loss of around $15 billion due to positions no longer justifiable by actual market performance. As panic set in quietly, suggestions to halt trading practices and assess exposure became more prevalent within company leadership teams. Despite these revelations, FinTech Dynamics continued to grapple with the implications of their algorithmic change. The data science team discovered links to vendor dependency on external data inputs central to their models. and essential data providers' feeds were shown to have inconsistently aligned with the edited algorithm, resulting in compounded inaccuracies. Internal tooling aimed at validating algorithm performance suffered from weak controls, which allowed the flawed version to propagate across client systems unnoticed. By the end of January, several firms faced liquidity shortages, prompting many to engage in hurried sell-offs to mitigate losses. The internal chaos at FinTech Dynamics escalated in parallel with external pressures, leading to frantic discussions in incident response meetings and the establishment of a dedicated incident channel to address rising client concerns. The lack of clear communication policies around algorithm updates contributed to mismanagement of the crisis. Incorrect assumptions about the nature of the volatility surrounding trading activities led to further delays in corrective actions. Simultaneously, external signals intensified as media scrutiny began to mount. Editorial commentary speculated on the potential for systemic instability within the financial sector. Financial experts weighed in, warning that the fallout from algorithmic trading errors could stretch far beyond individual firms, contributing to a loss of trust in algorithm-driven investment strategies. As February approached, the situation unfolded into a complex web of technical failures and financial ramifications. In quiet corners of Wall Street, discussions began regarding the implications for regulatory oversight in algorithm-driven finance. Regulators, observing the rapid deterioration of market conditions, scrambled to understand the source of the issue, not yet fully recognizing that the catalyst lay within a minor adjustment made just weeks earlier. Amid the intensifying crisis, FinTech Dynamics found itself at a turning point. With repeated failures in their communication streams and a growing demand for accountability, leaders within the company realized they would need to confront the repercussions of their algorithmic error. Each day brought renewed concerns over the systemic impact of their actions, and as reports of financial distress deepened, the question loomed. Could a seemingly minor technical oversight lead to a national financial crisis? The stage was set for an escalation of events that would soon spiral beyond the walls of FinTech Dynamics, plunging the financial industry into uncharted turmoil. On February 5th, internal alarms within multiple banks reached critical levels as liquidity issues became undeniable. The situation called for immediate action from prudential regulators, leading to a series of emergency meetings convened by the Federal Reserve and other financial authorities. These discussions underscored the unprecedented nature of the crisis, characterized by an alarming interdependence of algorithm-driven trading systems and traditional banking infrastructures. As major players revealed escalating financial instability, there was increasing chatter about potential bailouts amidst fears of a cascading market failure. By mid-February, the situation escalated as a significant financial institution formally announced insolvency due to sustained losses attributed to faulty algorithmic trading strategies. This event triggered widespread panic among investors, prompting a mass withdrawal from equities. Financial news outlets rapidly magnified the crisis, drawing attention to the troubling link between algorithmic errors and real-world impacts. Reports detailed losses exceeding $30 billion across various banks, highlighting the scale of the problem. In response, regulators initiated a clampdown on trading practices and began to examine the robustness of algorithmic systems across the market. On February 15th, a formal inquiry was launched into FinTech Dynamics, with requests for documentation detailing decision-making processes related to the problematic algorithm modification. law enforcement agencies joined the investigation due to rising concerns over market manipulation stemming from negligence. In tandem, on February 20th, multiple banks issued widespread account restrictions and liquidity safeguards to better manage the crisis. Audits of the trading algorithms were mandated, prompting firms to temporarily halt automated trading while they reviewed their systems for similar vulnerabilities. Client notifications about potential account freezes were sent as trust in these financial institutions plummeted. The exposure phase accelerated with media investigations starting to unveil the depths of the crisis. On February 25th, financial reporters obtained internal communications from FinTech Dynamics that revealed ignored warnings from analysts who had cautioned about the potential risks of algorithm changes well before the incidents unfolded. Details published in court filings and leaked chat logs detailed an atmosphere of pressure to meet client expectations that led to rushed decisions. As March unfolded, the repercussions resonated widely across financial markets, leading to further institutional collapses and mandated reforms. Legislative bodies started drafting new regulations around the transparency and risk management of algorithmic trading. On March 10th, a significant congressional hearing was held, during which executives from FinTech Dynamics were summoned to explain the operational failures that led to the crisis. The hearing captured national attention, laying bare the inadequacies of both the corporate governance practices and the reliance on algorithmic accuracy in investment strategies. Prolonged investigations culminated in on-site audits conducted by financial authorities, which revealed the degree of oversight and compliance breakdowns within FinTech Dynamics and its clients. On March 30th, criminal charges were filed against several key executives of FinTech Dynamics, with accusations including fraud and negligence linked to misrepresentation of the algorithm's stability. As the months progressed, firms that relied heavily on FinTech Dynamics technology faced severe operational disruptions, with some entering bankruptcy by late April due to irreversible losses. The crisis triggered structural shifts within the financial industry, where reliance on automated systems became a contentious topic of discussion among stakeholders, as evidenced by declining trust rates reported in financial surveys. By June 1, 2023, the legal fallout resulted in settlements amounting to billions, as aggrieved investors and institutions sought reparations for losses incurred. Meanwhile, FinTech Dynamics, suffering from irrevocable reputational damage, announced its intent to dissolve its operations, ceasing all algorithm-based services entirely. IRS audits targeted companies that had used the flawed algorithm, revealing widespread financial malpractice. By the end of June, the financial landscape had fundamentally transformed, with stricter regulations governing algorithmic trading now in place. The once thriving fintech firm, once seen as a market leader, was officially liquidated, with final proceedings closing its doors in September 2023 and effectively ending its operations with minimal salvageable assets and a tarnished legacy. Final status report. As of September 30, 2023, FinTech Dynamics has dissolved, leaving no operational components. All criminal charges against involved executives remain active, implicating them in ongoing investigations with potential indictments to be determined by the courts by the end of 2023. The financial sector has seen a sharp reduction in the use of algorithmic trading systems due to reputational damage and regulatory scrutiny.